Hi, Richard here on Thursday the 12th of August. I wanted to show you this weekly chart of the Dow. This is the end of the bull market in October '07. You can see how it's run down here to March '09. We've retraced exactly 61.8%, also against the 200 moving average. Left shoulder, head, right shoulder. These patterns generally can be measured pretty easily by copying from the neckline, as it's called, to the top of the headline. We can see that that target is about 8,500 on the Dow, so that's 20-odd% down from where it is at the moment. This is a bearish reversal candle. It's a bearish engulfing candle. It changes our primary trend. It comes off this 12-month long resistance line right here. So indeed, we've got a very bearish outlook that's coming up, that's been forecast for some time. I wanted to show you the daily chart of the Dow, where it's come down and hit resistance at 38.2% and then pulled back quite sharply. This has all happened in just a matter of days, so I haven't counted these up, but you can see that overnight, yesterday, it just simply unwound a number of weeks of trading activity in really quick style. We've got an increase in volume as well, even though it hasn't broken above this particular trend that you can see runs down there. The fact is that volume is increasing on the way down, which is another bearish signal. On the Australian side, we can see that, if I can find the chart, this is what we've been trading. It was an entry short here. Any stop losses should be above this market, about 4,580 points. The entry to the downside was set up by this bearish engulfing pattern, which was mentioned in the forecast or the short-term updates. It broke through yesterday, and overnight, this is the futures, of course, on the SPY. It's traded down very heavily, hitting, in fact, a first target at 4,379. We'd expect some pullback here. These things simply don't go in a straight line, although we can see this move down. This was very, very fast and unwound all of this complicated overlapping correction. But the next target, 4,258, if you're not in, we'd be looking to do so on a retracement up towards 4,450 odd. If it indeed makes it that far, I'd be looking for a daily reversal candle and you know, getting in for this ride down, because once this target unfolds, then we're looking down at this previous support at 4,100 points, and then indeed we can measure this and it would suggest about 3,600 points there. The next chart I'd like to show you is the Australian dollar. This is a weekly chart. You can see here that it's a bearish engulfing pattern, a big one that's been set up. Again, it's changed the trend from up to down, and we'll trade it down accordingly. So now we look at a daily chart of the Aussie dollar, and you can see that it has in fact broken down from this rising wedge, which is a double zigzag. It was connected by this X here from this complicated correction, A, B, up for C, and then a little 5-wave down, and then come up in the ending diagonal. It broke over yesterday, overnight, traded down very heavily, and this is today's trade range here. Wouldn't be surprised to see it track back up. Should retrace something in the order of around 100, 150 pips. We can put a Fibonacci retracement on that to get a feel for it, and even though that's a pretty tight drop, the target would be 91.16 or 91.10 for a 61 retracement. As we move from here, I'll show you a chart of the euro, which was the second largest drop on record. In October 2008, during the GFC, was the last time we recorded such a drop. It has severely broken this long-term support line, which started in mid-June, as well as on the relative strength index. You can see that it's broken down. That also held up since effectively mid-June, and that divergence gave us the confidence to actually initiate the long trade on this one. But what would he expect? Well, again, we'd be looking for a slight retracement and then a push down to targets that we can have a look at now on the Fibonacci extension, taking it from a previous wave 4, looking down, 122.17 would be a target, and indeed probably around the 200 period moving average here would be support too, around the 1.27. That would be the initial support, depending on what happens on the news overnight. If there's positive news that comes out, this might retrace quite violently to the upside. So stops need to be pretty wide. Risk needs to be no more than 1 to 2%. Moving to the gold weekly, you can see this long-term support running from the beginning of 2009. Acted as fantastic support. We had this hanging man or hammer, in fact, is the bullish pattern. Last week, of course, we came up for a correction. The big issue here is that a lot of people are considering that it's on its way up to 1400 or more, but I think the reality could be something else depending on how deflation emerges as a negative to gold. Gold is not in accordance with deflation, so what we'd expect to see is around that 1220 mark some resistance, the end of wave 2, and then a breakthrough, a very heavy breakthrough. This long-term support would give us the confidence that gold is in fact moving lower. In the event that it actually maintains this support and tracks up, then $1,403 was the Fibonacci extension target, but yet that remains to be seen. On the daily chart of gold, you can see here that this was the channel that we got stopped out at 1190 on. We've had a relatively strong move back up. These usually happen in 3 waves, so A, B, and C. It might work its way up towards here to the 1230 mark, and then we'll look for resistance and an entry short if in fact it gives us that confirmation. Targets for gold already been hit once through this support line, 1156. If it breaks through 1109 with a deeper retracement or deeper impulsive move, it would be of $1,043. Okay, that's it. Thank you.